Hello, welcome back. In this lecture, we start our tour of financial instruments with money market instruments. Specifically, you will learn about main types of money market instruments. We will talk about federal funds markets and the LIBOR market, the most marketable money market instrument, treasury bills, repurchase agreements, commercial paper, etc. After this lecture, I expect that you will be an expert on money market instruments and the language and the terminology that go with money market instruments, and finally their main features. We will talk about long-term debt instruments in the next lecture. Money market consists of very short-term fixed income securities. It is a very important segment of financial markets as it serves three important purposes. First, it provides investors who would like to invest in very liquid assets, a market where they can do so. Second, it provides those who are in need of short-term liquidity, a market where they can borrow from. And finally, and very importantly, it provides the Federal Reserve Bank, the US Central Bank, a channel to conduct its monetary policy by influencing the availability and cost of liquidity in the money market. Let's start with the federal funds market. In the US, all banks are required to maintain a minimum balance of reserves with their local Federal Reserve Bank. These are called federal funds. The amount of reserves that each bank needs to maintain depends on the amount of the deposits that it has. Now, at any point in time, some banks may have more funds or excess funds than they need, and others may be in need of funds. So those banks that have excess federal funds can lend to those that have a shortage of federal funds. The interest rate on these interbank loans, which are typically overnight transactions, is called the federal funds rate. Now, while most individuals like you and I cannot participate in this market, it is still a very important market, and it is still an important rate because it is influenced by Federal Reserve's open market operations to follow a target rate and is therefore seen as a key barometer of monetary policy. Here I have a graph that plots the daily effective federal funds rate, which is basically the average of the overnight federal funds rate computed daily. As you may know and can see in this plot, this key rate has been close to zero for a very long time, since about 2010. Now, the equivalent of federal funds rate in the London money market is the LIBOR. LIBOR is also a key interest rate because it serves as a reference rate to many other financial contracts, such as derivatives, mortgages, commercial loans, etc. Now, interestingly, the LIBOR is not derived directly from actual loan transactions. It is calculated based on responses to a daily market survey of participating banks. It is based on what each bank estimates their interest rate that it can borrow overnight to be. Now, what do you think the issue with LIBOR is? Well, for starters, one concern may be, how truly does the survey-based measure reflect banks' cost of overnight borrowing, especially at times of financial distress? Now, indeed, during the financial crisis, it appeared that banks underestimated their cost of borrowing in order to make themselves appear financially stronger. More importantly, it also emerged that several participating banks were in fact colluding to manipulate the LIBOR rate in a way to profit from their derivative trade positions. It emerged that traders were secretly communicating with each other to ask for higher or lower submissions that would be more favorable to their trade positions. Of course, lawsuits followed subsequently, and several banks had to settle with large fines following these lawsuits. Now, the most marketable of all money market instruments are treasury bills. The US Treasury borrows from the public by issuing Treasury securities. And T-bills represent the simplest form of fixed income securities. Now, Treasuries in general play a special role in financial markets. Because they are issued by the US Treasury, and therefore backed by the US government, they are viewed all around the world as default-free assets, or default risk-free. So the interest rate on treasuries is considered as the risk-free rate for different maturities. For that reason, they are also used as benchmark rates for many other fixed income securities. Now, what are treasury bills, or T-bills? Well, they are essentially zero coupon bonds with less than 1 year to maturity. They are issued at initial maturities of 4 weeks, 13 weeks, 26 weeks, and 52 weeks. So in 1 month, 3 months, 6 months, and 12 months. They are highly liquid, they're easily converted to cash, and they have very low transaction costs. A certificate of deposit, or a CD, is a short-term time deposit with a bank. Time deposits cannot be withdrawn on demand, and the bank pays the depositor interest and principal at the end of the fixed term of the CD. It is also an important money market instrument. Now, commercial paper is a short-term unsecured debt instrument that is widely used by large corporations. Instead of borrowing from a bank directly, commercial papers allow corporations to borrow from the public markets to meet their short-term financing needs. The maturities on commercial paper can be very short as a day, or up to 270 days. Now, while I said that commercial paper is primarily used to meet short-term financing needs, because the current rates have been so low, this has led firms to use this market increasingly for other purposes. So here I have an example from the Wall Street Journal of 2 companies tapping on commercial paper market to finance acquisition deals. Finally, I'd like to tell you a little about the repo market, as this is an increasingly important market for traders to borrow and lend cash on very short-term basis. So what is a repo, or repurchase agreement? Well, essentially, it is the sale of a security with a promise by the seller to buy the security back at a given price at a given date. So for example, the dealer sells T-bills to an investor on an overnight basis and promises to buy them back the next day at a slightly higher price. And the increase in the price is the overnight interest. And the T-bills serve as the collateral on this loan, basically. A reverse repo is the opposite of this transaction, where the dealer finds an investor with treasury bills, buys them back from the investor with an agreement to sell them back on a higher price on a future date, probably just not the next day. Essentially, repo agreements are collateralized short-term loans where the collateral is a security or a pool of securities. So in this lecture, we looked at money market instruments. You saw a wide range of money market instruments ranging from interbank loans to treasury bills, CDs, commercial paper, and repurchase agreements. Hello, welcome back. In this lecture, you're going to learn how to calculate treasury bill prices. So remember, treasury bills are short maturity, zero coupon bonds issued by the US government. Because they are often used as a benchmark asset, they're important enough to learn the little institutional detail of how to calculate their prices. So what you're seeing is a screenshot that I took today from the Wall Street Journal's market data section. So what you see is the bid and ask prices for treasury bills with various maturities. And here I enlarged a small part for you. So for example, the bid price for the treasury bill with a maturity of September 1st is 0.348. The promised yield to maturity is reported in the last column and is computed on the ask price. Conventionally, the bid and ask prices you see for treasuries are discounts for a $100 face value 360-day treasury bill. Now, probably the bills that you're going to be interested in aren't going to have $100 face value or will not be for 360-day maturity. So we need to make an adjustment to the discount to actually find the price. Okay, so how do we do that? Well, in general, the treasury bill price is given in this way. So the treasury price is the adjustment that we're going to do is we're going to take the face value, and then we're going to multiply it by 1 minus small d 360. Okay, so what are these? Right, where small cap d I'm going to define as the discount code that we actually can read off, right? And this is going to be in percent, okay? And capital D is the days to maturity, okay? Whatever the remaining days to maturity of the treasury bill is. And why 360? Well, it's just simply a convention. That's the way it is. Okay. So, for example, the bill that we see with the maturity on September 1st, we said that it has a discount of 0.358. And today it has 86 days to maturity. So what would be the implied price for $100,000 face value? Okay, so I'm going to find the implied price for this treasury. I'm going to take the face value, multiply it by 1 minus the quote, which was 358%, right, times 86 over 360. Okay? And if you compute that, you're going to find that the price for this treasury bill would be 99, let me look at my notes here, 914.478. Okay? So we computed this off the discount that was the quoted for the bid price. Now let's similarly find the ask price. The ask quote was 0.348. And so what is the implied price? Again, for a face value of 100,000, we're going to adjust it by 1 minus 0.348% times 86 over 360, right? And what you find is 99,916.867. So what does that mean? Right? You would buy the treasury bill for this price, right? Hold it for 86 days, and you would receive the face value of $100,000. Now you can ask yourself, well, what is the yield, right? So we can also find the promised yield over this period, over 86 days, right? Remember, the yield to maturity is simply the internal rate of return on the bond, right? In other words, what is the internal rate of return over this period, right? So what we're looking for is we want to find the rate that's going to make this equal to the present value of the face value. Right, the face value is 100,000 divided by 1 plus the IRR. Right? We're looking for the internal rate of return, or the rate that's going to make the present value of the face value equal to the price today. Right? And if you solve for that, you're going to find that it is 0.0832%. These numbers are really, really small, of course, right? Because the interest rates are currently very close to 0, right? What if we, so this is the rate over the 86-day period, right? What if we wanted to express this as an annual rate, or what is known as the bond equivalent yield, right? Well, that's usually expressed as an APR, as an annual rate. So I'm going to annualize this. How do I do that? Well, take the 0.0832%, multiply it by the number of 86-day periods in a year, right? And what you're going to find is 0.353%. Okay? And this is the yield that was reported in the last column, say some rounding error. Okay, so in this lecture, you learned how to calculate treasury bill prices from the discounts that they are typically conventionally expressed as, in, for example, in the financial press. Hello, welcome back. In the previous lecture, we looked at money market instruments. Remember, these are short-term fixed income securities with a maturity of less than 1 year. In this lecture, we're going to start looking at longer-term debt instruments. And we're going to start with treasury securities. Specifically, we're going to look at longer-term treasury debt instruments, such as treasury notes and treasury bonds, and TIPS, which are Treasury inflation-protected securities. Now, last time we talked about the fact that Treasury securities are considered risk-free. Because they are backed by the US government, they are typically viewed as having no default risk. And therefore, they are also used to set benchmark rates for a bunch of other financial instruments. US Treasury is the largest single issuer of debt. Just the sheer size of the volume of total debt and the size of any single issue makes the market very active and very liquid. So at times of high market volatility, Treasury securities are usually considered as a safe haven. In the previous lecture, we looked at US Treasury bills, which are essentially zero coupon securities with a maturity of less than 1 year. The Treasury also issues Treasury notes and Treasury coupons, which are coupon securities. In other words, both Treasury notes and Treasury bonds make semi-annual coupon payments, as well as the principal payment at maturity. Treasury notes and Treasury bonds differ in their maturity. Treasury notes are issued with a maturity of 2 to 10 years. And Treasury bonds are issued with a maturity of 10 to 30 years. We call the most recently auctioned Treasury issues for each maturity the underrun issues. And these are more liquid and more active, whereas the prior issues for each maturity are referred to as off-the-run issues. And these are less liquid and require higher yield. So here I have a list of Treasury issues that I compiled from the Wall Street Journal. Okay, so in this column, you see the range of maturities all the way to 30 years, to 2045. In the second column, we see the coupon rate. Now, remember, the coupon rate is not the interest rate. It just tells us what the fixed coupon payments will be on the bond. So let me pick an example. Let me pick this May 2020 Treasury bond with a coupon rate of 1.375%. So that tells us that each semi-annual coupon will be 1.375% of par value, which is 1,000, divided by, because it's 2, because it's semi-annual. The next two columns show us the bid and the ask price. Remember again that the bond prices are expressed as percentages of par value. So if we wanted to compute the bid price on this particular issue, it would be 99.8516% of par value. So it would be $998.51. Similarly, the ask price is going to be 99.8672% of par value, $998.61. The last column gives us the yield to maturity. What is yield to maturity? Well, you may recall that yield to maturity is the rate of return that is promised by the bond today. So in other words, if an investor buys this bond today at this date, collects the coupons, and holds it until maturity, collects the face value, the investor would earn a rate of return of 1.407% on the bond. Around the world, governments issue bonds that are linked to some kind of cost of living index to provide investors with an instrument to hedge for inflation. In the US Treasury issues TIPS. In other words, Treasury inflation protected securities. How do these work? Well, the principal on these bonds is adjusted periodically in proportion to the increases in the consumer price index. In other words, by the inflation rate. And because the principal is adjusted, the coupon payments are also adjusted, and therefore they provide a constant stream of real inflation-adjusted dollars. And the yield on TIPS should therefore be interpreted as the inflation-adjusted interest rate or the real interest rate. Now, to see how the TIPS work, let's compare the cash flows on a 10-year Treasury bond to a 10-year TIPS. Okay, so here I have a 10-year Treasury bond, and let's suppose that it has a 5% annual coupon rate, and let's suppose there is 4% annual inflation. And this graph shows the nominal and the inflation-adjusted cash flow. So the blue lines, or the blue bars, are the nominal cash flows, and the red bars are the inflation-adjusted cash flows. Now, you see in this graph that while the coupon payments are constant in nominal terms, I don't know if you can see, but the blue bars are constant in nominal terms. Of course, due to inflation, they are getting smaller and smaller in real terms. So the red bars are getting smaller and smaller. And the face value is fixed at 1,000 in nominal terms, but of course in real terms, right, 10 years from now, it's much less. Now let's consider a 10-year TIPS, okay, where the principal is adjusted for inflation rate every month. Now this time, what we see is that the coupon payments are constant in real terms, because they are adjusted every month with inflation, and the nominal coupons are growing, right, to make up for the inflation. Notice that the face value is fixed at 1,000 in real terms, but of course in nominal terms it will be a lot bigger because it will be adjusted for the inflation. So here I have the yield on a 10-year Treasury bond and the yield on a 10-year Treasury, well, TIPS for the last 10 years or so. Of course, they move in tandem, right? And the difference is, of course, is what the inflation rate is. In this lecture, we talked about Treasury notes and Treasury bonds, which are longer-term debt instruments issued by the U.S. government, by the U.S. Treasury. We also looked at TIPS, which are inflation-protected securities issued by the Treasury. Hello, welcome back. In the previous lecture, we looked at long-term debt instruments that are issued by the Treasury. In this lecture, we continue our discussion with other types of long-term debt instruments. Specifically, we're going to look at corporate bonds, mortgage bonds, which are an example of asset-backed securities, municipal bonds, and we'll also take a look at some examples of international debt instruments. After this lecture, I expect that you will have a pretty good understanding of the fixed income securities universe, ranging from money market instruments all the way to treasuries and other long-term debt instruments. Firms can borrow directly from the public at large by issuing corporate bonds. Now, corporate bonds are typically coupon bonds. In other words, they make coupon payments every 6 months and also pay the face value at maturity to the bondholder. I encourage you to review the optional video on principles of bond valuation to remind yourself of these features. The bond contract between the issuer and the bondholder is called the bond indenture. The bond indenture specifies all the features of the bond. So, for example, it will specify the coupon rate, it will specify the maturity, the face value, as well as any other covenants that the bond may carry. Now, the biggest difference between corporate bonds and the Treasury bonds is that corporate bonds are subject to default risk or credit risk. That is, there is some likelihood or probability that the firm may not be able to meet its payments on the bond. This likelihood is evaluated by credit rating agencies and is indicated by a credit rating. Of course, the higher the likelihood of default, or the riskier the bond is, the higher will be the promised rate of return on the bond. All right, so here I have a list of corporate bonds that are currently being traded in the market. So the top panel is the investment grade bonds with low likelihood of default, and the bottom panel consists of some examples of high yield, or what we call speculative or junk bonds, and these have higher likelihood of default. Each row in this table corresponds to a different bond issue. So in the first column, we see the issuer's name. So for example, Bank of America. And the second column is the symbol that is associated with the particular bond issue. So this is like the ticker. Now, the next two columns indicate the coupon rate and the maturity of the bond. Now, remember, this is all we need to know for us to actually know exactly what the promised payments on the bond are. So, for example, in this case, this bond has 3.3% coupon rate. Remember, coupon rate is a percentage of par value. So this bond will have 3.3% times 1,000 divided by 2. It will make a payment of $16.50 every 6 months. And at maturity, it will pay the face value. Now, the next column shows the bond's credit ratings as evaluated by Moody's, S&P, and Fitch. These are the leading credit rating agencies in the market, and each has a different scale. We will talk more about credit rating agencies in detail in a later lecture. The next three columns show the highest, the lowest, and the last transaction price for the bond. Now remember again that bond prices are quoted as percentage of par value. So for example, the last transaction price on this particular bond was 97.95, which translates into 97.954% of par value. So the bond price is 979.54. The last column is the yield to maturity. Recall that the yield to maturity on a bond is the average annual rate of return an investor earns if the bond is bought on this date and kept until maturity, collecting all the promised cash flows. Now, the bottom panel shows the high yield or junk bonds. Now, these are bonds that are issued by companies with poor credit ratings. So you can see the ratings as being significantly different than the top panel ones. Now, these are high risk, but they are also high reward. If the companies don't default, the investors can earn a nice premium on these bonds. However, sometimes they do default on their obligations, and of course, this is where the risk comes in. And you can see this as the higher yields on these bonds compared to the top panel. So here I have a graph of oil prices along with the return on ETFs on high yield bonds. So as you know, oil prices have been dropping significantly over the last year or so, and this slump in oil prices has led many fringe oil and gas producers that had issued junk bonds over this period to go into distress. And as investors have started pulling money out of these funds that invest junk bonds, the returns on these ETFs has plummeted. There are many types of corporate bonds. Corporate bonds, for example, can have floating rates. This essentially means that the coupon rates on the bonds are tied to some benchmark rate. So for example, it could be LIBOR plus some spread, and it fluctuates with this benchmark rate. Secured bonds are bonds that are backed by a specific collateral. In contrast, debentures are unsecured bonds that are not backed by a specific collateral. And subordinated debentures have lower priority to all other bondholders. Now, there are two important types of corporate bonds that I would like to talk about. These are convertible bonds and callable bonds. So a callable bond is a bond that allows the issuer to repurchase the bond back from the bondholder. So since the issuer is likely to do so when it is favorable to the issuer, these bonds are going to have higher yields to compensate the bondholder. In contrast, a convertible bond gives the bondholder the option to convert the bond into a specified number of equity shares. Now again, since the bondholder would use this option when it is favorable to do so, the bondholder would accept a lower yield on such a bond. Now, you may have heard the important role played by mortgage bonds in the last financial crisis. So what are mortgage bonds? Well, mortgage bonds are essentially an example of asset-backed securities, which are securities that are backed by a pool of loans or other receivables. And this process is called securitization. In the case of mortgage bonds, mortgages are bundled up together, and as payments of these mortgages are collected in the pool, the mortgage bond pays its interest and principal from this pool of cash flows. Mortgages are not the only type of loans. Student loans and car loans are also used to create asset-backed securities. In fact, late David Bowie also had his own asset-backed loans. He sold $55 million of bonds, which were essentially backed up by his future royalties. In other words, the payment on these bonds would be paid off out of his royalties that were collected in a pool. Another segment of the long-term debt market consists of municipal bonds, often referred as munis. These are issued by state and local governments. Now, they are especially attractive to investors in high-income brackets because the interest in income on munis are exempt from federal taxes. Lastly, I would like to give you some examples of international bonds. Now, there is really no clear classification of international bonds. A euro bond, for example, is a bond that is denominated in a currency other than the country in which it is issued. So, for example, a euro-yen bond is a bond that is denominated in yen but issued outside of Japan. Sovereign debt issued by governments is also a segment of the international bond market. These are obligations of a government of a country. They are referred to as the country's debt, as in the example of Greek debt or emerging market debt. So in this lecture, you learned about key features of long-term debt instruments such as corporate bonds, which are essentially issued by corporations to raise debt capital. We talked about mortgage bonds, which are examples of asset-backed securities. We also looked at some examples of municipal bonds and international bonds. In this module, we started our overview of financial markets and instruments by looking at some big picture questions like, why do financial markets exist? What role do they play? How are financial assets different than real assets? So remember that it is financial markets and financial instruments that help us direct the flow of savings and investment in the economy from the suppliers of capital to the users of capital. Financial markets help facilitate transactions, transfer economic resources, allow pooling of risk, and help aggregate diverse sources of information. No wonder there is a strong correlation between a country's GDP growth rate and how developed its capital markets are. In this module, we also started our overview of financial instruments by looking at the simplest kind of securities, fixed income securities, essentially the bond market. You learn about the shortest term instruments, money market instruments, which include federal funds market, short-term treasury bills, which are, remember, examples of zero coupon bonds. You also learned about longer-term debt market, which includes corporate bonds, sovereign debt, mortgage-backed securities. Specifically, you learned what cash flows are associated, for example, with a typical coupon bond, how we describe them, and how you would find the value of a coupon bond. Congratulations on making it through the second module. Hello, welcome back. In the previous lectures, we looked at fixed income securities, ranging from money market instruments to treasury bonds, corporate bonds, etc. In this lecture, we turn our attention to equity securities.